How can you pay zero tax while selling any of your investments legally, and where to keep your money for your short-term goals, for money that you need in, say, the next 3 years? We're going to dive into that today. For those of you who don't know me, my name is Uday Nadhe. I have been licensed in the financial services space in India since 2015, first in insurance and then in mutual funds, and so far I've worked with over 1,000 families. Having said that, let's dive straight into today's topic, where we go through the India tax subreddit, where this one person is paying 20 lakhs per annum in taxes and they're hurt because of that, obviously. A salaried professional says that I don't get any benefits from the government, I work hard to earn this money, and the tax collected is distributed to people who are kamchor or vote bank or drink alcohol daily. Fair point. Not a rich person, I don't own a house or any luxurious items. Tell me ways to save tax. This person already knows of ATC, HRA and home loan, but they don't help much. So let me share a tax hack with you through which you can save lakhs if not crores of rupees. It's possible thanks to section 54F of the Indian Income Tax Act, and it gets triggered when you're selling any of your investments to buy a residential house. So generally, let's say you have been investing in equity mutual funds, which are mutual funds that invest in stocks. Then eventually, when you sell them, you have to pay tax on the profit that you make. The amount of tax that you pay is dependent on how long you've been holding that investment for. If it's been less than 1 year, then whatever gains you make are taxed flat at 15%. So let's say you invested 1 lakh rupees. Now that has grown to 1.5 lakh rupees. So your gain is 50,000 and you've sold that within 1 year. Now that 50,000 will be taxed at the rate of 15%, that is 7,500 rupees. What happens though when you have been holding that investment for more than 1 year? In that case, every financial year you get 1 lakh of tax-free gain. It is called as long-term capital gains. What happens though if your profit is more than 1 lakh? In that case, all the profit that you make post that first 1 lakh is taxed at 10%. I'll share an example so you understand this better, and I will use this person's situation where they're paying 20 lakhs per annum in taxes. So a rough calculation would tell me that they are possibly earning about 70-75 lakhs pre-tax, 50 lakhs post-tax, which gives them an in-hand monthly income of around 4 lakhs, a little above that, we'll consider 4 lakhs. In that case, let's say they're investing 1 lakh rupees per month in an SIP. And now we'll go through some numbers so that we can figure out how much tax they would save if they use the benefits under section 54F when they're buying a house. And there are certain factors that you need to fulfill to get this tax break, and we'll get into that in just a bit. So their SIP amount is 1 lakh. We have an estimated return of about 12%. Let's say they have an annual step up of 10%, which means that as their income goes up, as the years roll, every year they'll increase their SIP amount by 10%. So right now it's 1 lakh, next year it will be 1,10,000, the year after that 10% higher than that, which will be 1,21,000, and so on. And they keep doing that for 10 years, which will give them 3.37 crores over a 10-year period. This is fantastic. Now, how much tax would they otherwise pay on this particular investment? Now, they've invested 1.91 crores over the entire 10-year period, and the gain would be 3.37 crores minus 1.91 crores, which in this case would be 1.46 crores. Now, let's say they wait for 1 year before they sell all of this amount, and that 1 year, let's say the market stays constant. So the gains and the value of the money remains the same. The gains would be 1.46 crores and the total value would be 3.37 crores. Now remember, every year they get 1 lakh of tax-free gain, which makes their taxable gains 1.45 crores. The long-term capital gains tax rate is 10%, so they would end up paying a long-term capital gains tax of 14.5 lakhs. Now here's the thing, if they use the proceeds of this investment when they sell them to buy a residential house, then their tax liability goes down to 0. Now there are 4 factors that need to be satisfied for section 54F tax break to be applicable. The first one is the gains that you make have to be long-term gains, and the definition of long-term is different for different assets. So let's say you're investing in equity mutual funds or stocks, In that case, you should have held them for more than 1 year for them to be long-term gains. If you are selling gold jewelry or gold coins, then you should hold them for 3 years for it to be qualified as long-term gain. Again, 3 years for a commercial property, and once again 3 years if it's a hybrid fund, which is a mutual fund that invests both in stocks and bonds. The one asset that is not allowed where you can't get this gain is a residential property, because that in a way gets covered under section 54. We'll talk about it in some other video. Then number 2, you should not be holding more than one residential property at the time of selling that particular investment to avail the benefit under section 54F. So if it's a second residential property, that's okay, but if you already own 2, then you cannot avail this benefit. Then number 3, the residential property must be purchased 1 year before or 2 years after the sale of that particular investment for it to be valid for section 54F. And if you're constructing a house from ground up, then the construction should be complete within 3 years of the sale of that investment. And number 4, the maximum total deduction that you can claim under section 54F is 10 crores. Earlier there was no limit, but after the 2023 budget, this 10 crore limit was set up. So keep this in mind when you're buying a house, because it's amongst literally the only times where you'd get away with paying 0 tax when you're selling an investment. Moving on to our second post from the day, and this is from the India Investments subreddit. This person saying parking emergency funds, which one is ideal in 2024? Options are ultra short-term debt mutual fund with no exit load, regular bank savings account, bank fixed deposit, and are there any other options? As per my modest analysis, ultra short-term mutual funds seem the best. Returns around 7-ish XIRR, savings account is like 4%. They've also provided us with additional information that they're in the 30% tax bracket, so taxation becomes an important point, and they have a much larger emergency fund, because in savings account, every year 10,000 rupees of interest is tax-free across bank accounts in one financial year. So because that interest that they're getting surpasses 10,000, I'm guessing it's a larger emergency fund. So now let's go through different options. First up, in emergency funds, you need to be mindful of 3 very important factors. The first is safety. Wherever you're putting your emergency fund money should be a non-volatile asset. So it cannot be the stock market or equity mutual funds, because its value goes up and down. And when you may need that money, you could be in a position where that investment is 10% down and now you have lower money for your emergency. Secondly, liquidity, because emergencies come unannounced. So you should be able to take out money from that emergency fund whenever you want without any restricting terms and conditions. And the third is returns, which by no means should be the only driving factor when you're choosing where to invest in an emergency fund, because the objective of an emergency fund is for it to be safe and it to be liquid. So you can redeem it at any point you want. Having said that, let's go through these various options now. I have prepared this small Excel sheet, which you can get, by the way, down below in the description. There's a link to it and you can use it and put in your numbers. So let's say this person has invested 10 lakh rupees in their emergency fund and they're in the 30% tax bracket. So we'll just enter 30%. Now I've got various assets of where this emergency fund can be invested, starting from fixed deposits to even arbitrage funds. We'll get into what these are. But the past 1 year return is essentially something that I've taken as an average. So for example, the average liquid fund in the past 1 year has returned 7.08%. There are liquid funds that have done better than this and worse than this, but I've just taken the average. Same is the case for ultra short-term funds and arbitrage funds. Now, if you look at the post-tax returns, you will see arbitrage funds here have the highest post-tax returns of 6.69% in the past 1 year. All these assets, by the way, are safe and are liquid. So the first 2 conditions get ticked off, and then amongst them, arbitrage funds have the highest return. The reason for that, if you notice, is the lower taxation rate for arbitrage funds after 1 year. All of the other instruments are taxed at your highest income tax level, which in this case is 30%, whereas arbitrage funds are technically categorized as equity funds for the purpose of taxation. We already know that if you hold an equity fund for more than 1 year, then the tax that you have to pay on the gains that you make is 10%. And even here, you get 1 lakh of tax-free gain across your various equity instruments, including arbitrage funds. Now you may be wondering, if arbitrage funds are equity instruments, then aren't they risky? Which is a perfectly rational question. And arbitrage funds don't become risky at all because they play between the difference of 2 prices of what is happening in the cash market on the stock exchange and what is happening in the futures and option market. And the fund managers would enter into a position knowing that there's a price difference, knowing that a security is priced at 100 rupees in the cash market and maybe at 100.2 rupees in the FNO market, and then will buy and sell simultaneously. So arbitrage funds are very safe. In fact, I personally have got my emergency fund money now in arbitrage funds. Now, one point you need to be aware of while investing in arbitrage funds is that they have an exit load for the first 1 month in most cases. Their exit load is small, it has a lower duration. So after that 1 month, if you withdraw, that exit load is not applicable. Having said all of that, the way I invest my own emergency fund money is by having a very small amount in my savings account. So I can pay for things right away without placing any redemption orders. Because with arbitrage funds, if I place a redemption order before 3 p.m. on say a Monday, I'll only get that money on a Tuesday. With the ultra short funds or liquid funds, I get that money even later. If it's a holiday, then count that extra day or extra couple of days. So the savings account is my direct access, but it's a small amount because I am confident of being able to use my credit card and being able to pay for it before the final bill date. Because if I'm swiping, let's say 1 lakh rupees on my credit card, I would just place the same redemption order in my emergency fund, let's say an arbitrage fund, and I would use that money to pay for the credit card bill. I would never ever swipe my credit card for money that I don't have. So there you go. Hope that helped you out. Do hit the subscribe button down below and like this video to make the YouTube algorithm happy.